Welcome, friend. Welcome, pilgrim. Welcome, rising investment guru, to the temple of the divine dividend discount models. Here you will learn true knowledge that will help you tilt the odds in your favor for stock choices that produce wealth over long periods of time. Okay, let's cue the music there. Okay. My apologies. Much of what we say today is going to seem mystical and magic. But no, it's actually very simple, folks. The techniques you will learn today are not that hard. The calculations are very simple. It's the concepts that get people upset and worried. Don't worry about it. Just do the calculations enough times, and then you'll I understand what I'm doing. Okay? So trust me on this one. Because it's going to sound a little funny at first until you speak the language. Are you on slide 17? Are you ready? Are you ready to enter the temple, dear student, dear pilgrim? Let's get started. The dividend discount models are a whole series of different models that you can explore. We're only going to do a few of them, the most important ones in my humble opinion. And so the dividend discount models value shares of stock on the basis of the present value of the future dividend streams that the stock is projected to produce. Dividends don't lie, right? We love dividends. It's money in our pocket, cash in our account. They go by various names: dividend valuation models, discounted cash flow models. If you recall, in our previous presentation, we stated that the value of a stock is based on the present value of its future cash flows. Therefore, these dividend discount models should be extremely popular, right? Well, during the 1990s, when the market went in two directions, up and way up, investors who adhered to these types of models were considered old-fashioned and outdated fuddy-duddies. But those investors weathered the 2000 to 2002 downturn very well. Dividends have become very important again. How did they do in 2008? Well, everybody fell down, but they didn't go down nearly as far as the more speculative growth stocks did. Dividends don't lie. Slide number 18. In its purest incarnation, it looks like this. Now, don't worry about the math. It's actually not that difficult. That's just in a mathematical formula so that it looks like it's college, right? The value of the stock is equal to the present value of all the expected future dividend payments. So what does this formula mean, those of you who are watching? You take the dividend for year number 1, and you divide it by 1 plus K. What is K? I don't know why they use K. That's your expected return. In other words, what do you want to return from the stock? Do you want 5%? Do you want 8%? Do you want 12%? And then you add that to the dividend in year number 2, divided by 1 plus K squared, multiplied times 12. And then you add to that the dividend in year number 3, divided by 1 plus K to the third power. So on and so forth, on into however many years you want to go. You add up all those terms together, and you get price sub-zero, which is a fancy way of saying what you think the value of the stock is worth. I don't really appreciate these mathematical symbols. They're great for mathematicians, but they scare the rest of the population. So we take the dividends in year numbers 1, 2, 3, 4, upward as far as we want to go, And each year we divide it by 1 plus k to the first, 1 plus k to the second, 1 plus k to the third. And again, remember, the k is our expected rate of return. What we hope to get, what we expect, what we reasonably, well, we should be reasonable, expect to get from the stock. Does that make sense? Now, in the 7th edition, all the editions have the same example. They have this one stock that has 3 annual dividends of $100 per share and then promptly goes out of business. I haven't figured that one out yet. And they want a 15% rate of return. I think they're way out of line here. I don't try to get 15%. I don't suggest that you try to get it either, but maybe you will. So you take $100 divided by 1 plus 1.15, 1 plus 15%. That's 1.15. You should be able to figure that out after previous lecture, right? And you add to that $100 divided by 1.15 squared to the second power. And add to that $100 divided by 1.15 to the third power. You add all those together and you get $228.32. So we believe that if we require a 15% rate of return, which I think is unrealistic, but hey, let's do it for the sake of argument. This stock that's going to pay us $100 in year 1, $100 in year 2, $100 in year 3 would be worth $228.32. But how many businesses pay 3 annual dividends and then promptly go out of business? Plus, we keep using this term present value. Present value. What does present value mean anyway, Bayano? Slide number 19. What is present value? Present value is the value of a lump sum or a series of payments to be received at some future date. Not today, we're going to get the money in the future. What's it worth to us today? It's the opposite of the future value calculations. The inverse, right? The inverse operation. Did you work on the optional future value calculations in Chapter 1? Or have you taken Business 121 where we really hammer these calculations down? Future value, we go from an amount today or a series of investments that we start today, and we go into the future. We determine what it's going to be worth in the future. Present value, we start from the future, a value we're going to receive in, say, 10 years or 20 years or the next 10 years, and then we bring it back to the present. So the future value of $10,000 in 10 years at 8% is equal to $21,589. Here's the future value multiplier, and there's the formula. So if we had $10,000 today, in 10 years, if we get 8%, we're going to have $21,589. The inverse, and notice that it's underneath the divide symbol, that's the inverse operation. If we believe that we're going to get $21,589 in 10 years, and we require or we expect an 8% rate of return, then what is that worth today? There's the present value multiplier. You multiply the 21,589 times the present value multiplier, and you get $10,000. So what would you rather have? $10,000 today or $21,589 10 years from now? If you require or expect or are hoping for an 8% return, you don't care. They're equivalent. Present value, future value are just two sides of the same coin. And if you want to, you can run back to Chapter 1 and look at those future value calculations. You don't have to do them. We sort of looked at them very quickly when we went through Chapter 4 and saw what we could do by simply putting $50, $100 a month away or whatever. You saw those, right? So you know we can build wealth at 8, 9, 10%. Now we're going to decide, okay, if we require 8%, what is this value we're going to get in the future worth to us today? That's what present value tells us. It tells you what the future value is worth today. Okay, now I know some of you are going, huh? Would you repeat that? Go ahead, stop. Go back and listen to it again. But even if you don't understand it, don't stop now. Keep going, because the calculations are easy. The calculations are very easy once you've done them a few times. It's the concepts that tend to trip people up. All right? So let's continue on slide 20. Did the formula for the dividend discount model scare you? It has squares and exponents in it, and it's got all those symbols. Well, look, the formula has the present value calculation built into it, but we mortals simply use the present value tables, and then later on we're going to use a spreadsheet. Just as we use the future value tables in Chapter 1 or Business 121, Financial Planning and Money Management. So the formula becomes the value, the present value, what we believe the price should be, is equal to the dividend 1 times the present value multiplier. That's what PVM stands for. Present value multiplier for year number 1. And then we add to that the dividend for year number 2 plus the present value multiplier for year number 2. And we add to that the dividend for year number 3 plus the present value multiplier for year number 3. Are you getting the picture? It's not that hard. So the present value multipliers come from the table, and we'll take a look at that table a little bit later. Slide number 21. Let's do the same example over again. Using the present value multipliers from the present value table on the class website, and you could find them in Canvas, you take those present value multipliers, and let's go grab them right now. Okay, so here's the present value table with the present value multipliers. For year number 1, we go across to 15%, 0.870. Let's go back and make sure I did that right. Yes, $100 times 0.870. So that's $87. In other words, today, if we're going to get $100 a year from now, we say, oh, at 15%, that's worth to us today $87. Does that make sense? The present value is $87, the future value is $100 at 15%. If we change the expected rate of return, then the value is going to change. Try it with other values. And you're going to hear this term. That's why these are called dividend discount models. It's called the discount rate. I know, it's a horrible name, and it reminds people of Target and Macy's and Penny's, but no, that's what you want to discount that $100. That $100 you're going to get a year from now, today, discounted back to the present, is $87. Now let's go back to the table for year number 2, and we find the present value multiplier is 0.756. All right, and so that's what we did here. We took $100 and multiply it times 0.756, and that's $75.60. $100 2 years from now is worth to us today $75.60 if we required 15%. And the last one, we won't go back there, but the last one is 0.658. And that's what we're going to get 3 years from now. The dividend in year number 3 is $100 times the discount rate times the present value multiplier of 0.658, $65.80. $100 3 years from now is worth to us today $65.80 if we require a 15% rate of return. And if you add those three up, you get $22.40. I'm sorry. And remember the previous slide back that when we did the calculations using a calculator with 20 digits of accuracy gave us $228.32. So we're 8 cents off. That's because we're only using the 3 digits of accuracy in the present value tables. So we're 8 cents off. So if we are going to get $100 in year number 1, in year number 2, and year number 3 at 15%, we're going to get $300 over 3 years, but today it's only worth to us $228.32. The sum of the present values of the future dividend cash flows equals our perceived value of the stock. And again, if it sounds like magic, like prestidigitation, relax, do the calculations. You'll do the calculations, and you'll see it's really not that hard. Slide 22. Let's take a look at the first dividend discount model. This is called the zero growth model. This assumes that dividends will continue at a fixed rate indefinitely into the future. And so what we take is the annual dividends and divide it by our discount rate, our required rate of return. And so say we had a company that was paying us $3 per share. And this company's been paying $3 a share for the last several years, and we expect them to continue to pay $3 a share. So if our required rate of return is 6%, we take $3 and divide that by 6%, 0.06, right, 0.06, and you get $50 a share. We would be happy to pay $50 for this share of this company because we are going to get basically 6%, $3 from them every year. Does it look familiar? Well, really, it's just another way to view the dividend yield. It's just another way to look at our stock's dividend. So if you remember the dividend yield, that was the annual dividends divided by the market price on slide 23. Well, the dividend yield is equal to the annual dividend divided by the market price. So basically what we did is we swapped the value of the stock with the required rate of return and the dividend yield with the market price of the stock. We basically just rewrote the formula, putting the value of the stock over here on the left-hand side and the required rate of return in the bottom. And so the value of the stock is basically equal to what we believe the market price is. Now remember, the market, investors are going to not necessarily agree with us, but that's what we believe it's worth. So investors who emphasize the zero growth model are valuing the stock almost exclusively for its dividend yield. In other words, remember when we talked about growth and income mutual funds? Well, they're not interested in the growth. They're the equity income investors. Railroads, food companies, companies that are very stable, utilities that pay a stable dividend. Okay? And very, very straightforward, isn't it? Annual dividends divided by the required rate of return. So let's take a look at a real-life example on slide 24. This is a company called Consolidated Edison, which we don't hear too much about here, but it's the utility for New York City. It's been around for since the 1880s or something. It's been around a long time. This is Mr. Edison, Thomas Edison's utility company, and the current market price as of March 1st, 2019, is $82.66 per share. It's currently paying about $2.96. It's currently paying $2.96 in annual dividends. And it's been paying $2.96 for a long time. So the question is, what is our required rate of return? Well, if we use 8%, we take $2.96 divided by 8%, which is 0.08. Do it. Make sure I didn't mess up, because I make a lot of mistakes, students. $2.96 divided by 0.08 is $37. The stock's selling for $82.66. So the stock is overpriced if we require 8%. What about 5%? Well, $2.96 divided by 0.05 is almost $60, $59.20. So the stock is still too expensive for us if our required rate of return is 5%. With a market price of $82.66, the stock is yielding 3.59%, which when you go back in time, utilities typically returned much more than this, which is yet another indicator to me that prices as a whole are pretty rich, pretty dear in the United States. And I don't know when it's going to happen, but we're long overdue. But hey, you young folks, this will be the great opportunity for you to keep putting $50, $100 a month away into your mutual fund. Or if you're savvy, you'll have some cash on hand and jump in with both hands and grab shares of stocks that you have been watching for a long time. That's called a contrarian investor, folks. So let's continue. That's the zero growth model. And there's a worksheet that in the face-to-face class we would now start working on and do the utility. It's always going to be utility, folks. They're going to be in the same order. It's always going to be the utility for the zero growth model. Slide 25. The constant perpetual growth model. This assumes dividends will continue to grow at a specified rate perpetually into the future. Now, this constant perpetual growth model, that comes from the Department of Redundancy Department. Constant perpetual doesn't mean the same things. Anyway, this one is a little trickier. It's actually, it's the previous model, but we add a few terms. We take the value of the stock equal to the annual dividends times 1 plus the growth rate. You see, before, if you go back to the previous slide, you'll see that it's just annual dividends on the top. And then divided by the required rate of return minus the constant growth rate. So you see in the previous slide it was just the required rate of return. We added these two terms, one on the top and one on the bottom, to account for the fact that this company has been growing their dividends at a certain rate of return and a certain growth rate, and we expect it, or we're hoping that it'll continue to go into the future. So in the book, depending on what edition you have, it's like around page 180 something. You take $10 per share. This is what this company has been paying. And if you have an annual growth rate of 5%, that's $10 times 1.05. Hopefully you're getting this now. You've done it a few times. That's $10.50. Now, if again we expect 15%, which I think is way too much, dear students, 15% minus 5% in the bottom, that's 10%, 0.1. You take $10.50 divided by 0.1, 10%, and you get $105. We believe the stock should be worth $105 per share. Now, you go out to the marketplace, you go out to run over to the internet, or open up your phone, and you see it's selling for $200 or $50. The market has a different view than we do normally. Sometimes we agree, a lot of times we don't. Make sense? So now let's take a look at a real life example. In fact, let's take a look at several. And these are all blue chip type companies, large cap multinationals that have their roots deep in the economy. These are the companies that I recommend to you should be the bulk of your investments. Sure, buy a fast-growing titter or farce book or whatever every once in a while, but for every one of those, will you buy 5 of these? Okay. Now, stop playing. I keep, I'll preach at you later on too. So we're on slide 26. 3M. Who are they? Well, you know them. Yes, you do. Have you ever used Scotch tape or Post-it notes? 3M changed their name back in the 60s when it was Science and the Modern World in the Atomic Age. For many years, they were Minnesota Mining and Materials. That's where you get the 3M. And the current market price as of March 1st is $207.49. And they're currently paying $5.76 in annual dividends. Now let's assume that the dividends are growing around 8% a year. All right? If we require 13%, well then here's the formula. You take the dividends, $5.76 times 1 plus 0.8, 1 plus 8%, And you divide that, make sure you have to do the top first and then the bottom, and then to do the divide symbol. You divide that by 13% minus 8%, 0.13 minus 0.08, and you get about $6.22, 0.08. You can be as specific as you want. Divided by 0.05, and you get approximately $124. You know, we don't want to be too precise. Well, we'll talk about that later on. So, it's selling for $207. It's not a great buy if we require 13%, is it? No, it's not. But what if we just lowered our required rate of return? Remember, we're the ones deciding what our required rate of return is. I say I'm very happy with 8, 9, 10%. You give me 8%, I'm a happy man. You give me 10%, I'm floating. And so 5.76 times 1.08, excuse me, that doesn't change. What changes now is our required rate of return. The 13% becomes 10%. And so 10% minus 8% is 0.02, 2%. So $6.22, 08, divided by 0.02 is $311. So look how sensitive the model is. The model is very sensitive to our choice of our required rate of return. Simply by adjusting our required rate of return. Look, you happy with 8%? You happy with 12%? You decide. And by simply moving that percentage up and down, you see the value just change tremendously. Do you think 3M is a good value? Well, folks, they've been around for I don't know how long, decades. And they're one of the Dow stocks, well, they're in the Dow Jones Industrial Average, so they're one of the premier stocks in our economy. And yeah, they make thousands of products. Most all of them are flat, reflective tape and connectors and all kinds of good stuff. They're a great company. They've been around, based in Minnesota, of course, Minnesota Mining and Materials. Slide 27. McDonald's. Yeah. Well, I don't know. That stuff is bad for you folks. I mean, you make a whole lot of money if you can sell people fat, sugar, and salt. And in the last 20 years, even though they've said, publicly, oh, we want people to be healthy, they've made them even fatter. They've made, excuse me, they've added more calories to the darn things. But it's a blue chip stock. It's one of the Dow Jones Industrial Average. And the current market price is $185.05 as of March 1st. It's paying $4.64. Now let's assume again that the dividends are growing around 8% per year. If our required rate of return is 13%, and I want you to do these, folks, they're not that hard. Do the calculations. They're not that hard. $4.64 times $1.08. I'm sorry, not $1.08, 1.08. It's 1 plus the growth rate. And then that's $5.01 with a little numbers. You don't have to get rid of the numbers. You don't have to leave them. We're not trying for precision here. We're just getting spitballing, as some people say. We're just getting close. Divide that by 13% minus 8%, which is 5%, 0.05, and we get $100.22. Well, Intel, I typed the wrong company. McDonald's doesn't quite measure up to our 13% rate. What if the required rate of return were only 10%? Well, then we redo the calculations. $4.64 times 1.08 divided by 10% minus 8. And that's that same $5.01 divided by 0.02. And that's $250, give or take. Yeah, if we're willing to accept a lower rate of return, McDonald's looks pretty good to us. And folks, you can make a whole lot of money selling people fat, sugar, and salt. I said that once, I'll say it again. I can't stand the place. I go by there on my bicycle and smell that grease and just think, why do people eat that stuff? But others love it. It's good for your veins. It coats your veins really. Anyway, let's stop it. Stop preaching, Piano. Stop preaching 20. And I'll fix that Intel. It's supposed to be McDonald's. Slide number 28. Target. Target, the fabulous exclusive French department store. Yes, the current market price as of March 1st was $72.94. It's currently paying $2.56 in dividends, and let's assume that dividends are growing around 8% a year. You've done this do it again. You do this calculation until you can see it in your mind's eye while you're sleeping. $2.56 times $1.08, that's $2.76, thereabouts, 77 cents, divided by 13% minus 8%, or 0.05, and we get $55, which is so much for being bombarded by the color red, right? Well, what if we reduce our required rate of return, our discount rate? You're going to hear people say who are in the business and looking down upon you thinking, who are you? You don't understand discount rate. What if our required rate of return were only 10%? What if our discount rate were only 10%? Well, then we do the calculation again with 10% instead of 13%. $2.56 times 1.08, that's that same $2.76 thereabouts. 10% minus 8%, 0.02, $138. Maybe we ought to spend more time researching Target. And yeah, I know, Target does not have a reputation for being the most elegant, cool, hip store in the neighborhood, but it is pretty darn profitable. And I don't know about you, but every time I go in there, it's darn crowded. So, but notice, they are not a multinational. They, unlike Costco and Walmart and now Amazon, Home Depot, have not expanded outside the United States. They tried moving into Canada, and it didn't work very well for them. They had to run back into. They're based, and I don't understand why, because they're based again in Minneapolis. They're based in Minnesota, so you think they know the Canadian market really well. I don't understand. I don't follow them that much. I don't follow retailers because I hate shopping. I'm the worst person to ask about shopping because I absolutely hate it. I go in, do what I have to do, and get out. Kind of like a bathroom for me. Slide 29. My apologies. Pfizer. Pfizer? Who are they? Oh, you know who they are. They're a drug company. They make many different drugs. Their most famous drug is Viagra, with all the jokes that go with Viagra jokes. But they make one of the most popular drugs in the world. It's called Lipitor. It's a statin. It's for not blood pressure. It's cholesterol pill. And people have to take it every day, and that's the kind of, if you're a drug company, that's the kind of drug you want, something that people have to take every day. So the current market price is $43.36 on March 1st, and it was paying $1.44 in annual dividends. Again, let's assume the dividends are growing around 8% per year. What if our required rate of return is 13%? Well, do the calculation, $1.44 times 1.08. That's about $1.55, give or take, $1.56. 13% minus 8%, that's that same 0.05, and we get $31.10. Pfizer doesn't look so good if we want 13%. But how about 10%, huh? $1.44 times 1.08 divided by 10% minus 8%, that's that same $1.55 divided by 0.02, and Pfizer looks like a great deal. We believe it's worth almost $78, $77.76. Do people stop taking their medications just because the economy is in recession? No. Do they take more drugs because the economy is doing really well? No. So drug companies tend to be fairly defensive, fairly dependable. The kicker with the drug companies is that cycle of patent expiration. And so that to them is just life and death. When a drug goes off patent, they lose a lot of money, but they're always creating new drugs, so I would not want to be the managers, the higher up level executive managers of drug company, because the pressure is on to keep coming out with these blockbuster drugs that people have to take every day. They don't want a drug that you take once and you're fine. I mean, that's a mess to them. I'm sorry. Okay. Let's continue. Slide number 30. Altria. So Altria, who are they? They make Marlboro cigarettes and Virginia Slims, tobacco. Those little white tubes of tobacco. Current market price is $52.75, March 1st. Currently paying $3.20 in annual dividends. Let's assume the dividends are growing around 8% per year. With that same required rate of return of 13%, we get $3.20 times 1.08. That's about $3.45, 46 cents. Divided by the 13% minus 8%, 0.08, and we get $69.12. And it's selling for $52.75. Our model says that Altria is worth $69.12 if we expect 13%. What a buy! If you conveniently ignore the fact that tobacco kills 400,000 Americans each year, would you buy a stock from a company that sells a product that when used as directed kills its consumers? Well, as a matter of fact, it's a pretty darn good investment, folks. Cigarettes, how much does it cost to make a tube of tobacco? A little over a penny. And they sell 20 of them for $8. Now, a lot of those taxes, but still, it's been one of the best stocks in decades, over decades. Right. And I'm telling you, folks, I think that once marijuana is finally legal at the federal level, you know who's going to, they've already bought into one of these companies, and who's the other one? Reynolds, British American Tobacco, and the other tobacco companies. They're just waiting for marijuana, because did they know tobacco? Did they know, should they know marijuana? Yeah. Now, I have had an off and on relationship with this stock. My wife always told me never buy it. Shh, don't tell her I did. And I remember watching an interview with a gentleman who was a mutual fund manager. He was on a company called a program on PBS, that bastion of communism and socialism. For many years, they were the only place on the television that had any kind of financial investment show, if you can believe that. Every week, Wall Street Week with Louis Rukeyser, and this was many years ago, dear students. And Mr. Rukeyser asked this gentleman, I don't remember his name, now, sir, because he was very big on Altria. It was called Philip Morris at the time. You're very big on Philip Morris, aren't you, sir? And he goes, yes, sir. He goes, now, sir, you're a Mormon, aren't you? Oh, yes, sir. And Mormons don't smoke. Oh, yes, sir. No, we don't smoke. And he said, well, how do you square that round peg? I mean, how do you come to grips with the fact that you're buying a company that produces a product that you religiously believe is wrong? And he said, well, sir, Mr. Rukeyser, there are no secrets here. We know this product is dangerous. We know it will eventually kill you in almost all cases. And there are, especially if you use it, if you buy a pack a day or something like that. If you smoke a couple a day, it's not good for you, but it doesn't do as much damage. And so there are no secrets here. And so I don't feel morally corrupted by investing on behalf of my clients. They know what's in the portfolio. They know that I buy Altria, Philip Morris, the company that produces Marlboros. And so I feel very comfortable with that. And I always wonder, I said, does he really? Because I don't really feel that comfortable with it, even though it was the best stock I ever owned. Anyway, so would you buy Altria? And in the investment club I was in, I recommended it, and a couple, I think 2 or 3, definitely 2, said, no way, we're not buying Philip Morris. It's not going to happen. And they were morally against it. So you have to decide, would you buy a company like Altria, or a company that makes guns or nuclear weapons? That's sometimes called socially responsible investing, or deforest the rainforest. let's continue.
Hey,
Who is this?
Baiano.
Who are you?
You know who it is.
It's my conscience.
Come clean.
Come clean about what?
Fess up.
Fess up about what?
Where did you get the assumed dividend growth, huh?
I made them up.
Huh?
I made them up. All these companies are growing their dividends faster than 8%.
That's better.
Ugh, I hate when my conscience gets into the act. Slide 31. The constant perpetual growth model is very sensitive to the assumed growth rate of dividends. The recent dividend growth rates of 3M, McDonald's, Target, Pfizer, and Altria are all 8% or better. McDonald's 8.2, Pfizer 8.5, Altria 12%, 3M 12.9, and Target 13.8%. But the model does not work if the required rate of return is equal to or less than the dividend growth rate. You get division by zero or negative prices. I mean, that doesn't make any sense. Therefore, we should actually raise our expected rates of return for all of these companies. All of them are actually better buys than what the model is telling us for our 10 or 13% rates of return. Now note that these are blue chip companies with long histories of rising dividends, but they're not alone. Check out ExxonMobil, Procter & Gamble, United Technologies, Abbott Labs, AbbVie, who are they? Check them out. Johnson Controls, Microsoft, Ford. You know, the companies that we think of, not that exciting. You think of Ford, not that exciting. Procter & Gamble, what do they make? Pampers and Charmin and Tide and Head and Shoulders and Gillette razors, stuff that people use every day. And so this model pushes us towards those types of companies so that we are not going to explode on the upside. We're not going to have stocks that are on the cover of GQ and Vanity Unfair, and they're shown on the nightly news with their glowing white teeth and beautiful hair and gorgeous pecs. But they're also not going to crash and burn like a GoPro, right. And if you don't know what I'm talking about, go look it up. GoPro, yeah. Look what happened to those people. Okay. So, the news is good, again, but there aren't that many of them out there, folks. These are the blue chip companies that are called, and so they're not exciting, but they're there, and I hope that, as I said before, for every one Twitter or Facebook or whatever, or new Snapchat, you buy 4 or 5 of these things. How's that? Is that a deal? All right. Now, continuing. The constant growth model takes the constant perpetual growth model one step further by adding yet another scary-looking term to our model. It assumes dividends will continue to grow at a specified rate for a specified number of years. Do we really have to know this? No, don't. It's basically the same thing. Adding an additional term makes it a little bit more precise, but as we're going to discuss, we don't want to be precise because we don't really know how many years they're going to continue the growth. Well, here's the constant perpetual growth model here. The current dividend times 1 plus the growth rate divided by our expected rate of return minus the growth rate. And then we add this, which basically says, okay, it's going to happen for a certain number of years. Okay. We're not going to do any calculations with it. You decide whether you want to use it or not. Okay, I think the company's going to do this for 5 more years. And then after that, they're going to stop growing. You decide. I don't use it. But it's there. And there are dozens of others, dear students, that you have an entire lifetime to play around with. Yes, trust me. Slide number 33. The two-stage dividend growth model. which is also called the variable growth model, which assumes dividends will continue to grow at a specified rate into the future, presumably the fast growth state, and then grow at a second, presumably slower growth state once the company matures. It's basically the model we just looked at with adding more terms. They're getting more and more impressive. I guess you can impress your friends and family by showing them these models and then tell them you don't use them. It may look impressive, especially to those of us who love math. My undergraduate degree was math. But it has some serious problems. It is very difficult to accurately predict dividend growth during the initial fast growth stage of a stock. Usually, companies do not pay significant dividends while they're growing rapidly. And this is something that I tell people, and they look at me like I'm from outer space, but many decades ago, Benjamin Graham warned, remember he's Mr. Warren Buffett's teacher, warned against using overly sophisticated mathematical models to value stocks. Because he was in the heyday of the 1950s and 1960s where they were applying scientific, and computers were very new, and they were coming up with these very precise valuations for companies, and he said it's bogus, and he was right. And I agree. So, don't mess with this. Slide number 34. Observations of the dividend discount models. How do we use them for a company that isn't paying dividend? Well, the simple answer is you can't. At least the ones we've looked at so far, because all the dividends are zero. The constant perpetual growth rate is usually an unrealistic assumption, except for those very small numbers of blue chip companies, multinationals that have their roots deep in the economy, that aren't going anywhere. They're not sexy, they're not exciting, but boy, do they deliver over the long term. And dividend growth rates are very difficult to estimate. With the large cap, well-established companies, historical growth rates may be useful, but with fast-growing companies and new industries, it's impossible. You don't know what's going to happen. They have to take those earnings and reinvest them into the company and grow the company. So they're not going to be paying you dividends. But when they do all of a sudden start paying dividends, then we sit up and take notice. The problems of the dividend discount models notwithstanding, repeat after me. The value of a stock, is based on the present value, of its future cash flows, Now go back, do these over again, go to worksheet number 1, number 2, do the constant perpetual growth models, and do them enough times so that you're, again, seeing them in your sleep. Because, students, just wait, the next lecture, you are going to see a version of the dividend discount model which is absolutely the best version, in my humble opinion. And you are going to see that we can even use it when a company isn't paying dividends. Very, very cool. See you in our next presentation where we discuss the discounted cash flow model.